Hey, Bulls and Bears, it's Wednesday, November 30th, 2022, the last day of the month of November. Wow. So now let's get into the first story without any hesitation here. Um, failed banking, failed banks have now become the new normal. Let me say that again. Failed banks have now become the new normal. There's an article out here that describes this. Now, most of you probably know this. What we talk about here a lot is the lifeblood of the U.S. economy is what? It is debt. Without the availability of people taking on ever increasing amounts of debt, the economy comes to a screeching halt. What we're seeing right now is not a screeching halt in the economy. It's a slowdown in housing and it's a slowdown in automobile purchases. But the accumulation of debt continues. So don't be fooled by that. If it wasn't for that, this economy would have collapsed a long time ago. Now, one of the keys to this lifeblood of the U.S. economy, which is debt, is fractional reserve banking. That means banks can loan out many multiple times amounts of money than they have in deposits or in their coffers and their reserves. That's known as the reserve requirement. But that's all completely been turned upside down. And that's one of the signals that should let you know that things today are much worse than they were in 2007, 2008, the financial crisis time era. And let me just try to explain this in simple terms. Right now, and there's an article out here, banks are short more than $1 trillion in capital. $1 trillion in capital. So if they use the accounting method known as mark to market, which is basically the assets that the bank holds is valued based on its current value, not what they bought it at, not what it may sell for in the future, but its current value. And now when you look at that type of accounting, mark to market, assets versus their liabilities, banks are a $1 trillion short. So that means they've loaned out way beyond what we've ever seen before in the history of banking. And, this has now been legalized. What I mean by legalized is there used to be a reserve requirement. That means banks had to have some capital in reserves to try to cover failed loans. Now they don't have to have any. The reserve requirement has been completely waived. We've had a zero reserve requirement now for over 2 years with the onset of the health crisis that was put in as a temporary way to help keep things moving. But a lot of times things that are temporary end up being permanent because once you slow down the issuance of debt, then you're in real trouble when it comes to the economy and jobs and growth and everything that's looked at as far as what an economy actually is when it's growing. So, wow. No surprise to probably most of you, but the number is pretty shocking. We're at $1 trillion. And we'll link to that article. Let's get into some other news here. Job openings plunged by 353,000 as hiring and quits tumble to multi-year lows. Remember this labor shortage that we had, and it's still true in some sectors. A lot of people were quitting their jobs. That has changed now. We hit multi-year lows in the number of people quitting their jobs. So this is a sign and a signal that things are really going to start deteriorating much more quickly with this economy. I've described this as a slow motion collapse, and that's what it is. We see shenanigans out there like the zero reserve requirement. We also see the Fannie Mae and Freddie Mac backing over $1 million mortgages now. So that's going to further incentivize banks to give out more mortgages when normally they would not. If banks had to be on the hook for this, first of all, they wouldn't have to have a zero reserve requirement. That would not exist if banks were on the hook for what they actually loaned out. We know at the end of the day, they're going to get bailouts if something does happen. But the things that are in place right now, it's basically endless debt. When you don't have to have any reserves, it's endless debt. They can give out endless amounts of loans without any repercussions. It's pretty crazy, but that's the way it is. And people now are more slow to quit their job. We see the amounts of debt that people are in. And used to be a lot of other jobs out there to move to or to hopefully trade up and get a bigger salary. Also, a lot of people were quitting their job to work in the gig economy. Uber and Lyft were two huge gig economy types of work that people did. And now with the fuel, the cost of fuel, that is a very, very challenging job to get by on right now. From this article here, 1 month after the August JOLTS report showed an unexpected surge in job openings following the dire plunge in July when nearly 1 million job openings were gone. Things are reverting back to normal because after the freak spike in job openings in the last month of the summer, which was then downward revised to 407,000. That's another thing. They often go back and make these revisions that reveal the truth and the reality. Now that November's in the rearview mirror, I think the real numbers are going to start maybe coming out here as far as this goes. Another sign of things plunging, and that's U.S. pending home sales plunged. Biggest annual drop ever, worse than the 2007-2008 housing bubble. After plunging by the most since the health crisis lockdowns, analysis expected U.S. pending home sales to tumble once again in October, and they did, dropping 4.6% month over month. And that's the fifth straight month of sales declines. Now, there's something happening right now in the housing market that's a lot different than 2008 also. Our inventory is much, much less than what it was at the onset of that 2007-2008 housing bubble. So that's going to be one of the big factors we have to keep an eye on in the housing market. When will sellers become so desperate they're going to be forced to put their home on the market? And homeowners, people that aren't even considering selling right now, I think a lot of homeowners are going to get desperate and they're going to be forced to put their home up for sale, otherwise, get it foreclosed. So that's when we see the real surge in falling home prices. The acceleration of the drop in home prices. When you see inventory start to spike rapidly, that's the sign that we're in the midst of a major housing correction. Right now, I think we're still at the beginning. Another piece of news out here, Jerome Powell came out and said he sees the rate somewhat higher down the road, but he needs substantially more evidence on inflation. Well, how much more evidence does he need? Just take a look around. Take a look at the U.S. consumer. He's not, the central bank and Powell both together, they're pretending like consumers are in a great spot. And they're looking at this holiday spending and they're saying, look at all this spending, which is mostly people swiping cards and taking on debt. They're saying, look at this. Consumers are strong. Consumers' balance sheets are wonderful because they still have home equity. For now, they have some home equity. Is that going to be like that 6 months, a year from now? And a lot of people are underwater. People that bought in the last 6 months to a year in certain areas, especially out here out west, are underwater on their mortgages already. But to say that the consumer's got a strong balance sheet and they're showing strength is just insane, ridiculous. Wow. Let's talk about the next CEO, the latest CEO to come out. Amazon CEO Andy Jassy was speaking during a live summit, and he said the following, quote, "The economy is a lot more uncertain than previously thought. We know what's happening at Amazon, the layoffs, the cancellations of warehouses, and construction of buildings. And Amazon sees what's on the horizon. And that's another reason why we saw such big holiday spending was these retailers, including online retailers, did some very deep price cuts. And people were enticed to go shop and spend more money if you believe the number that's put out there with the $25 billion plus spending over the Thanksgiving holiday weekend. More warnings out there from banks. Citi warns rolling recessions will shake the global economy in 2023. There's a new term for you. I haven't heard that one until now. Rolling recessions. So first it was rolling blackouts. Now it's rolling recessions. So this is going to be a domino effect that's going to go throughout the world. And I think in the next 6 months, you're going to see a rapid change in the living conditions of most people. About 70% of people are going to have to really cut back when inflation doesn't come down, or if inflation stays elevated. If we don't see deflation, let me put it like this. If inflation comes down, that's still not good, right? It just means that prices are growing, but more slowly. We don't need inflation to come down. We need deflation, right? we need a lower cost of living. Saying inflation is going to come down means the cost of living is going to continue to go higher, just at a slower pace than previous months. That's not what people need right now. People need deflation. People need a lower cost of living. Do you really think utility bills are going to drop? Do you really think the cost of fuel and energy is going to drop that much? You're going to see a crash in these prices. Do you really think home prices are going to crash or rents are going to crash? I think we'll see further corrections, but saying that a crash is going to happen in housing when there's Fannie and Freddie out there backing loans that are mortgages that are $1 million plus now, and the banks can just loan out all this money and have $1 trillion. They're basically underwater by $1 trillion. With shenanigans like that, how can there be any major crashes in prices? All right, so we're going to keep an eye on it for you here. As we survey the prospects of the global economy, we see many reasons for concern, including continued challenges from the health crisis and the Russia-Ukraine war, high inflation and headwinds from the central bank rate hikes. That's Citi chief economist Nathan Sheets. He wrote in some notes on Wednesday, reflecting these factors, the global economy is likely to endure rolling country-level recessions during the coming year. Well, it depends on if they ever acknowledge that there's a recession. I think there's a recession right now. We did see previously 2 consecutive quarters of negative GDP growth, and they just glossed over that. Of course, the third quarter, the quarter before the selections were made in early November, of course, they made that look very good as far as GDP growth goes. Let's talk about Elon Musk. Elon Musk is out there saying the Fed needs to cut interest rates immediately. It looks like he took such a big hit on Twitter and all the chaos that's happening at Twitter right now, that he needs interest rates to get lower so people can afford to buy cars again so they can move more Teslas. That's what it looks like to me. But this is an article out of Benzinga.com. Elon Musk says the Fed needs to cut interest rates, quote, immediately. And he also flashes a severe recession warning. I completely disagree with him. I don't think they need to cut interest rates. We don't need to allow people, or we don't need to make it easier for people to take on debt. That includes corporations and institutions that are waiting to pounce in this housing market. They're waiting to have an opportune time to buy. We actually saw in the third quarter, investor purchases of homes actually dropped from the previous quarter because they know, I think a lot of these institutions know that we have a much further correction to go through in the U.S. housing market. All right, so it's insane, folks. The banks, $1 trillion underwater. Failed banks is the new normal. What do you think about this? Please let me know. What do you think about Elon Musk, what he said to lower interest rates, the jobs number plunging by 353,000. It's interesting that came out, after November now is in the rearview mirror. Now they're going to tell us these real numbers, what it looks like. All right, that's it for this report, everybody. Thanks for being here. Keep stacking. Bye for now, and peace.